What if I told you that you already understand Bitcoin, you just don't know it yet? And I can prove it in the next 60 seconds. Everyone says that Bitcoin is complicated, that you need to understand blockchain, that you need to be a tech genius, that it's a young person's game. That's wrong. And by the end of this video, I'm going to prove it to you. Not by telling it to you, but by having you experience it for yourself. No tech skills required, no coding, no computer science degree, just the ability to think logically. Here's who this is for. This is for people who felt excluded from Bitcoin because they're not tech people. Maybe you've looked into it. Maybe you've read an article or watched a video, and within 90 seconds, your eyes just glazed over and you thought, no, this isn't for me. I don't want this. And you've given up on yourself. And that's your choice. But if you're willing to give me about 25, 30 minutes here, I'm going to prove you wrong. Hi, I'm Jay Scott. I'm from Montana, and I'm not a financial advisor. I'm not from Wall Street. I'm just a guy who woke up at 57 years old, ran some numbers, and realized that I'd been lied to my entire life. And today, I'm going to show you that if you can count to 21, you've got this. Okay, let me tell you something that might change how you feel about yourself. You're not bad at understanding crypto or Bitcoin. Crypto has been bad at explaining itself to you. Think about it. Who's been explaining crypto for the last 15 years? 20-something tech bros in hoodies drawing diagrams about decentralized peer-to-peer ledger systems and proof of work? Yeah, no kidding that you didn't get it. Nobody gets that when you explain it that way. That's not your failure. That's a failure of communication. It's like trying to learn to drive from someone who starts with the internal combustion engine. You don't need to understand how the engine works to drive the car. You just need to know how to steer it, how to brake, and how to go. The same thing is true here. You don't need to understand blockchain to understand why Bitcoin matters for your retirement. You just need to understand one concept. Just one. And you already understand it. You just don't know it yet. All right, you ready? Here we go. There will only ever be 21 million Bitcoin. Ever. That number is locked in. It can't be changed. No government, no company, no person on the earth can create more than 21 million. That's it forever. Now, how many US dollars exist? Trillions, and they print more every year. Remember that chart from the last video? The money supply that had gone from 900 billion to 9 trillion in 15 years? They can print as much as they want, whenever they want. So here's the question. If you have something with a fixed supply of 21 million, and you have something else with an unlimited supply that keeps growing, what happens over time? The limited thing becomes worth more. The unlimited thing becomes worth less. That's it. The entire foundation. 21 million versus infinity. Fixed versus unlimited. Scarce versus printed. If you understood that, you just understood Bitcoin. Can you understand that 21 million is less than infinity? Of course you can. You just explained Bitcoin to yourself. I want you to take a second with that. You probably spent months, maybe years, telling yourself that you couldn't understand this, that it was too technical, too complicated, too much for someone your age. You just understood the core concept in 60 seconds. Here's what actually happened. Nobody ever explained it to you in a way that respected your intelligence. They assumed you needed to understand the technology. You didn't. You needed to understand the economics. The problem was bad explanations, not your capability. Let me ask you something. If supply is limited and demand is rising, what happens to price? You already know the answer. You've known it your whole life. Supply and demand. It's the same principle that makes beachfront property expensive. The same reason a first edition book costs more than a reprint. There's nothing new here. This is economics that you learned in high school, just applied to a new asset. Now that you've got the foundation, let me add one more layer. Still no tech, just logic. Bitcoin doesn't just have a limited supply. It has a shrinking supply of new coins entering the market. Every 4 years, the number of new Bitcoins created gets cut in half. It's called the halving. In 2009, miners created 7,200 new Bitcoin per day. Today, it's about 450. In a few years, it'll be 225, then 112, and then less and less. So you've got demand that's growing, more people, more institutions, more countries showing interest, and supply that's shrinking, fewer new coins every 4 years, capped at 21 million forever. What must happen to price over time? This isn't speculation, this isn't hope, this is basic economics. Supply goes down, demand goes up. Prices must rise. You don't need a computer science degree to understand that. You don't need to know what a blockchain is, you just need to understand supply and demand. And you do. Let's put this in another context that hits even closer to home. On one side, you've got the US dollar, created by the Federal Reserve, no supply cap, no limit on how many that they can print. Since 2008, they've added over 8 trillion to the money supply. And every dollar that prints makes the dollar in your savings account worth a little less. You watch that happen in real time. You felt it at the grocery store, at the gas pump, at the doctor's office. That wasn't your imagination, it was real. On the other side, you've got Bitcoin, created by a set of rules that nobody can change. 21 million coins, period. No exceptions, no emergency printing, no government override. One is designed to inflate, the other is designed to be scarce. Now, if you're trying to save for retirement, if you're trying to preserve and grow your purchasing power over the next 15 years, which side of this equation do you want to be on? The one where everything is diluted every day, or the one that's mathematically fixed? This is economics, not technology, and you just understood it perfectly. Let me show you what this looks like on a chart. Again, here's the M2 money supply over the last 15 years. And here's Bitcoin's price over the same period. Notice anything? They move together. Not perfectly. Bitcoin is volatile. It goes up and it goes down. But the overall trajectory follows the money supply. Why? Because as more dollars enter the system, each dollar buys less. The hard assets, things with fixed supply, become worth more dollars. This is the same reason your house went up in price. The same reason the stock market went up. Not because houses and stocks became more valuable, but because dollars became less valuable. The difference? Your house appreciated at maybe 4 to 6% per year. The stock market, 7 to 10%. An asset with a fixed supply of 21 million and a shrinking issuance, well, it fundamentally has a different trajectory. I'm not making a price prediction, I'm just showing you the economic structure. Fixed supply plus expanding monetary base equals long-term appreciation. That's not speculation, it's math. Now, I know what some of you are thinking. But Scott, people lost money on crypto. It crashed. It's gambling. Let me address that head on. Yes, the price drops, sometimes dramatically. It dropped 80% in 2022. It dropped 50% or more several times in history. But here's what also happened every single time. It came back, and it came back higher. Why? Because the fundamentals didn't change. 21 million is still 21 million. The money printer is still printing. Supply and demand haven't been repealed. The people who lost money on crypto are almost exclusively people who bought high, they panicked, and they sold low. Short-term traders, speculators, people chasing the latest meme coin or listening to influencers, that's not what I'm talking about here. I'm talking about understanding the economics, buying with a long-term perspective, and letting the math work over 10, 15, 20 years. Sound familiar? That's the same philosophy your financial advisor preaches about stocks. Buy and hold, stay the course, don't panic, sell. The only difference is the vehicle. And as we discussed in the last video, the vehicle matters. Do you see that this is just economics, not technology? That's the breakthrough. Once you see it, you can't unsee it. Now, I know what the next objection is because I hear it every single day. Okay, Scott, I get the math, but can someone my age with my background actually do this? Let me introduce you to a few people. Linda is 57. She's a school administrator in Ohio. She uses her phone for calls and text. That's it. Her kids set up her email. She told me, word for word, I thought crypto was for Silicon Valley people. She watched a video a lot like this one, the 21 million versus infinity explanation, and something clicked. She didn't become a tech expert. She didn't learn to code. She opened an account on a regulated exchange, the kind that looks and works like a bank app, made her first purchase, and set up a monthly buy. Total time from I can't do this to her first purchase, 4 days. She told me the hardest part wasn't the technology, it was giving myself permission to try. Now, Gary's 54. He's a contractor in Tennessee, And yes, he literally still uses a flip phone. His words, not mine. I don't trust anything I can't hold in my hand. Gary wasn't interested in crypto at all. His son kept bringing it up at family dinners, and Gary kept shutting it down. Then Gary ran his retirement numbers. He really ran them. He looked at them, not the ones his advisor showed him, the real ones, adjusted for real inflation, the kind we talked about in the last video. The gap scared him, enough to listen, not to his son's hype, but to the math. Gary's flip phone didn't stop him. He did the research on a library computer. He opened up an account on his desktop at home. His son helped him with the initial setup, and after that, Gary managed it himself. He told me, this isn't about being tech savvy, it's about being honest with yourself about math. Gary's flip phone sits right next to a portfolio that's done more in 18 months than his 401k has done in 10 years. Let's look at Margaret. She's 61, retired teacher in New Mexico, never invested in anything besides her pension and a savings account. She found out about this through a friend at church. The friend showed her that the purchasing power chart, the same one that I just showed you in the last video. Margaret went home and she couldn't sleep. The next morning, she sat down at her kitchen table with a cup of coffee and a laptop. She watched 3 videos. She took notes in a spiral notebook, and she made her first purchase that afternoon. Margaret said something that stuck with me. She said, I spent 35 years teaching kids they could learn anything if they tried. I forgot to tell myself the same thing. She's been investing for 2 years now. She checks her portfolio once a month. She doesn't stress out about the ups and the downs because she understands the economics underneath it. Here's the point. Linda, Gary, and Margaret, same age range as you. Same doubts, same I'm not a tech person story. They didn't become tech people. They became people who understood the math. And the math doesn't care about your age or your background or whether you use a flip phone. If they could do it, what's really stopping you? Now, I want to address the other big objection, the one that keeps people up at 3 a.m. It's too late. Let me show you some math. If you're 55, you have roughly 180 paychecks before you turn 70. Let's say 15 years. Scenario A, you put $500 a month into a traditional portfolio, earning 2% real return. Now that's after fees and real inflation. After 15 years, you have about $104,000 in real purchasing power. Same scenario B, same $500 a month put into an asset earning 15% real return. After 15 years, you have about $348,000 in real purchasing power. Same person, same monthly contribution, same timeline. The only difference is the vehicle, $104,000 versus $348,000. That's not a small difference. That's the difference between I can't retire and I have options. Does 180 paychecks feel like too late now? Here's what everyone gets wrong about the too late conversation. They compare it to a 25-year-old. If you started at 25, you'd have millions by now. That's true. It's also completely useless. You can't go back 25 years. But here's what they don't tell you. A 25-year-old putting $500 a month into a traditional assets for 15 years ends up with roughly the same as a 55-year-old putting in $500 a month into a higher returning asset for 15 years. Let me say it again. Same timeline, same contribution, different vehicle, similar outcome. The 25-year-old doesn't have a time advantage. They have a vehicle advantage. They have 40 years to let slow growth compound. You don't have 40 years, but you don't need 40 years if you're in the right vehicle. 15 years is 180 opportunities. The question isn't whether you have time, it's which mathematical track those contributions travel on. And that choice, you can make it today. Okay, let's bring it all together. 1, understanding crypto doesn't require understanding technology. It requires understanding one concept, 21 million versus infinity, fixed supply versus unlimited printing. You understood that in 60 seconds. 2, the scarcity mechanism is basic economics. Limited supply plus rising demand equals appreciation. This isn't speculation. It's the same supply and demand principle you've understood your whole life. 3, people exactly like you, same age, same doubts, same I'm not a tech person identity, have already done this. Linda and Gary and Margaret, the barrier was never capability, it was permission. 4, 15 years is more than enough time. 180 paychecks is 180 opportunities. The variable isn't time, it's the vehicle. You don't have a tech problem. You don't have a time problem. You have a wrong asset problem. And today, you prove to yourself that you can understand the right asset because you just did. Welcome to the group. Now that you understand the asset, the question is, how do you actually start? In the next video, I'm going to walk you through the mindset shift that separates people who understand this from the people who actually act on it. Because knowing the math and making the move are two different things. I'll show you what strategic risk actually looks like. Spoiler, it's the opposite of gambling. And I'll give you permission to think about your financial future differently than you've been told to. You've crossed the understanding bridge. The implementation bridge is next. If you're watching this and something clicked today, hit subscribe. I put out new content every week for people over 50 who are ready to see the real math behind retirement. No hype, no tech jargon, just the numbers. And if you really want to understand this even more, download my free Wrong Asset Manifesto. It'll talk about some of the things we talked about in the last couple of videos, but we'll go into more detail. And I've actually got a calculator in there that you can plug in your number so you can see for yourself what these numbers really look like and how much the math really matters. So you sat through this 30 minutes of video with something that you thought you probably couldn't understand. And now you understand it, all of it. That tells me you're not the kind of person who just gives up. You just needed the right explanation. Now you have it. All right, I'll see you in the next one.